It's a pleasure to be with you guys. And, the idea for what I wanted to share with you today came from a number of conversations I've had with my own clients at my firm. And a lot of times what we try to do is deconstruct their routines, because a lot of times, behavioral biases and the way we're wired to make, in some ways, poor decisions with our investments, so many times can be shown to be a factor of how we've structured our days, how we've structured our process. And, if you don't have the right process for what you're trying to accomplish, a lot of times, regardless of, you're setting yourself up for failure, basically. You're setting yourself up to make a bad decision because you're not setting up the right routine to get you in the right mindset. So what I wanted to do was just share some general thoughts, and then actually show you what my morning coffee routine is. After I get the coffee, I sit down. How do I get a sense of what I need to be aware of in terms of market awareness and understanding where the opportunities might be? So just to introduce it, I had written an article for the STA journal, and the STA is the British Technical Analysis Association. It's been around for decades. And I wrote an article for their journal last year and titled it A Student Pilot's Guide to Technical Analysis. And as some of you probably know from what I've written and have been a guest on the show, I've talked about learning to fly an airplane and how that can be so many times related back to investing and charts and visually analyzing things and having discipline and a process and so forth. And I try to just summarize why it was such a good parallel for investing, and I think it'll help illustrate some of the points we're going to show this morning. And what I boiled it down to were there were three characteristics. There are three things you did as a pilot that you need to do as an investor. And the first is be prepared. The second is be aware. And the third is to be ready. And each one of those, very, very quickly, be prepared means you have to have a good game plan. And, Arthur Hill on Stock Charts does such a great job of, reminding people, plan your trade and trade your plan, and, have a good game plan before you pull the trigger on anything. And so many times we get caught up in the fear, the emotional drivers, what compels us to want to take a position, as opposed to having a clear, disciplined process ahead of time. So the very first thing you need to do is be prepared. And I think how you structure your mornings, how you actually start the day in terms of analyzing the markets and where they're at, can help you be prepared, or it can be a poor preparation if you do it incorrectly. The second thing is be aware. And what that means, the name of my firm, Sierra Alpha, comes from situational awareness, which is having an awareness of what's going on outside of the cockpit and understanding the environment around you. And as investors, it's so important to pay attention to our environment, understand what's working and what isn't. So Tom, your charts earlier, looking at all the relative strength characteristics of some of those charts, of some of those stocks, I think is so vital. And I find so many people make that simplistic error of just not paying attention to the relative positioning of different stocks. And as a result, you might have great analysis on a particular stock, but you're looking at the wrong stock in the first place. And what relative strength tells you is where the opportunity is. Is this the type of name that is going to, potentially, give me opportunity going forward? So the second item is to be aware, understanding what's happening. And again, charts I found are one of the best ways to have a market awareness. And I'll show you some of the ways that I do that. And then the third item after the first two is to be ready. And so part of understanding, part of having a good market awareness is seeing as things change, paying attention to key signals, key models, key indicators that are going to help you, have a good probabilistic sense of where the market could be headed and how you want to be positioned related to that. And again, with charts, with things like the market summary, the chart summary, the relative rotation graphs, you can get a sense of, where there's movement, where there are inflection points, where there are opportunities, and then you are then ready to take action. So that's the way I would think about sort of your morning coffee routine. How is that routine, the routine with which you start to look at charts first thing in the morning? How is that helping you to fulfill those three objectives: to be prepared, to be aware, and to be ready? And I would encourage you as we go through to think about your own routine. Think about what you look at first and what is the process, the order with which you look at things. And I'll try to explain why the order is so important as I go through my own example. And just a couple quick comments before I sort of get to my own charts. The first is we did set up a poll on the side of the screen, which I hope you'll take a moment to look. It's just paying attention to the S&P 500. And I'm very curious as to what people think will be next for the S&P. So I sort of gave you three choices. The S&P was around 28.25, went down to around 28.16 or so this morning. Right now it's settling in around 28.20. And it's where do you think the S&P will go next? What will it reach first? Will it reach the October 2018 high? That's your first choice, which would be, up in the 2,900 odd range. Will it retest the earlier March low and break that down to 2,700, which would be option number 2? We go lower first. And then option 3 is we stay within that range from around 2,700, around 2,950, and in the next 3 to 6 months, meaning we're really range bound within that extreme. So if you haven't done so already, I'd love for you to go in and just answer that poll, and then we'll refer back to it at the end of the presentation here. I'd also point out, I'd love, if other presenters, what I love about, watching Market Watchers Live is seeing, Tom and Aaron, seeing how you actually show your login, show your charts. And I get plenty of ideas just seeing how you lay things out and how you pay attention to them. So I hope my other fellow contributors can do that, because I think the more you see from people that are very familiar with a tool like this, I think the more you're able to take advantage of it. So I hope you're able to see that from some of the other presenters as well. So what I'm showing you now, I'm showing you my own login and showing you the market summary page. And the first couple charts are, maybe what your process kind of looks like. I'm not sure. And I know everyone's different. Your time horizon is different. How you're trying to win the game, your goals, your investment horizon, your universe of securities that you're picking, they could all be very different, each of you, and different from my own. But the question is just answer that question first. What are you trying to do? And then make sure your morning routine is setting you up to make good decisions in that environment. So what a lot of people do, I've seen when I work with them and we look at stock charts together, they start at a summary. They start with what's happening. So if you look at this, again, it's great information, but it is very short-term oriented. So immediately I'm seeing that most of the broad U.S. Equity indexes are down, again, midday on a Wednesday. I can then glance down and see utilities are the one index that's up, and everything else is down, but transport's really the weakest, with FedEx and others that Tom mentioned earlier. Energy is leading, financials are lagging, and so forth as I go down through here. So that's fine because it's good information. But again, what am I trying to do? Now, put yourself in my shoes for a moment. I'm more of a long-term investor. I'm looking 3, 6, 12 months down the road, trying to understand more of the long-term structural trends. So one of the worst things I could do is start with a very short-term oriented look, because I'm very much gearing myself, I'm priming myself to the current short-term intraday movements. And I shouldn't be structuring a long-term process based on, a couple hours of trading on a Wednesday in March. Now, the next thing you might do, and I hope not, is go to a very short-term chart. So, now that I'm looking at the last 3 days here on a 5-minute chart with the RSI at the top, with the MACD at the bottom, and I'm just looking at the last couple of days. So now I see that the S&P is down. I might want to see how that looks relative to the last couple of days, and I'm getting the short-term perspective. And again, both of those are fine charts to look at if you are really gearing yourself toward that time frame. But this process I'm showing you is very disconnected from how I'm trying to win the game, how I'm actually trying to make good decisions. So I would really encourage you, as I go through, I'm going to start with my own process and explain why I have things set up a certain way. And then again, I'd encourage you to think about your own process, how you have things set up, and are just a couple tweaks that you could make in your own login, in your own process, to set yourself up to make better decisions. So again, with the time frame I'm thinking of, which is looking 3, 6, 12 months down the road, I need to be starting looking at a pretty long-term stretch of time, because I want to prime myself to the long-term trend. I want to understand where things have come from and then focus in on where I should be going next. So we're now getting into my actual process. The first chart I look at every morning is a weekly chart looking back about 7 years of data. I'm going back to the 2012 low, seeing the 2015-16 correction here, and then seeing where we've gone to the first quarter of 2019, where we're at today. And again, it's not focused on the short-term movement. I'm not paying a ton of attention to the current price bar. I'm looking more at the overall trend. So, my general thesis on the markets has been we're in a secular uptrend, meaning, broadly speaking, we're in, depending on where you think it started in 2009 at the low, or maybe 2013 where we broke to new highs. We're 6 to 10 years into this bullish market. So, thinking about that long-term trend is the very first thing I'm starting with. The second thing then is, what is the cyclical trend? What is that intermediate term? And in my mind, we've been in a bearish cyclical trend with, after a period of clear accumulation, we've had this sort of consolidation pattern over the last year, more range bound, higher highs, lower lows, a broadening pattern. But overall directionally, I would argue sideways to down. So overall, that's rather negative. But on the tactical side, the short-term side, I can see that the market's clearly been appreciating since the December lows. But the goal here is to start with the big picture. So if I'm trying to understand the long-term trend, I need to start by looking at the long-term trend itself. Then I'm looking at the daily chart on the S&P 500 and just focusing on the short-term price action within that trend. So now that I understand my own view of the long-term trend, I then can look at some of the short-term trends and actually see where we're headed. Here I see some of the things like the initial thrust off the Christmas Eve low end of last year. If you take the corrective period we had at the end of January and project that same wave forward, that was sort of the objective of around 2,800, which is why these current levels make so much sense. And I'm also seeing if we would sell off or correct a little bit, I have some general sense of where I might expect some support here around 27.25, maybe the 50-day moving average in a similar level. I'm also seeing the bearish divergence that Tom mentioned on a number of charts. You see it on the S&P chart, arguably as well, with a higher high yesterday and a potentially lower peak here in the RSI. From then, I'm still, if you think about it, trying to stay relatively long term. So in my mind, I have a number of more longer term trend following models that I follow. And again, many people have some longer term moving average combination they might pay attention to. And for me, again, this isn't an output of my process, it's an input into my process. So it's part of the mosaic that I would paint to understand an overall market perspective. So in this case, excuse me, I'm looking at the 21 and 34 week exponential moving averages. And here I have the PPO just to show the difference between the two of them. And I can see that they crossed up about a month ago as the market obviously rallied so quickly out of the lows. And now I can see that very simplistic trend following model is more on the bullish side, telling me that the trend overall has been positive recently, which makes sense. I then have a series of other models looking at mid caps, small caps, and also global markets, just to get a sense overall. Again, if I know nothing else, what's the overall basic trend with each one of those? Then I start to get into some of the more particular indexes, right? And again, I'm not yet looking at what the market is doing today. I'm just looking at the long-term trend. And I think that's an important point. So many of us start with the current intraday movement and we think, okay, the S&P's up, it's down 50 bips. Okay, what does that mean? And from my perspective, even if you're short term, that should be toward the end of your process, not at the beginning. So you want to put that toward the end. Once you have a good sense of the trend, a good sense of where we're coming from, then you have earned the right to look at where we're at today. So now what I'm starting to do is looking at the S&P versus other broad benchmarks, Dow versus transports, to look at sort of a simplistic Dow theory read. Here I can see that, the Dow transports are arguably starting to, potentially get to the point where they're breaking to new swing lows. That would be sort of a negative from a Dow theory perspective. I can look at some of the different cap tiers, large versus mid versus small, and see if there's any differentiation here. So here, small caps well below the 200-day moving average, testing the 50-day from above. Compare that to the S&P 100, the mega cap index, well above both of those moving averages. So seeing that divergence between large cap, mega cap to small cap is something I might want to look at. And in some of these, the way that I have mine set up, and again, it's not perfect. This is just what I've done. I tend to use a lot of the candle glance charts and then zoom in and out to some of these. So with the mid cap index, for example, I might want to jump in and look at that chart in a little more detail. And then I have some notations I might want to draw with trend lines and key levels or something as a sort of a workbook, a reminder of what I want to pay attention to. But it's also worth noting that comparative charts have a great place here as well. So now instead of just looking at the prices, I'm looking at the relative movements of the S&P in black versus some of the other cap tiers, mid, small, and micro caps. So now that divergence makes even more sense, right? I can see the S&P 500 making a higher closing high in this last couple of days, where I can see small, mid, micro all have made lower closes over that period. So we're starting to get some dispersion even within U.S. market cap ranges, suggesting potentially some internal weakness. Then again, and again, this is not to tell you what your process should be, but just to illustrate what my process is, and hopefully get you thinking about how you might maybe just make a couple brief improvements to your own thinking or how you have things set up. I'm then looking at broad global regions and then at individual country indexes, things like China, Brazil, India, places where we've seen movement and seen opportunity. What are those relative movements to one another? And here, when you get to this level, you can start to see some real differentiation between different countries and different setups. And again, I also have some of the comparative charts set up here to show me, in this case, the US leading out of the December lows, with EFA, EM, frontier markets all lagging behind. Again, this is just returns over that period. Continuing on here, then I like to look at intermarket analysis. So Tom had mentioned interest rates, mentioned fixed income holding up so well. And here you can see the aggregate index, liquid ETF, the high yield ETF, all breaking to new highs, while equities have maybe lightened up a little bit. You can see commodities starting to appreciate, potentially breaking to new highs. And now we can see it relative to the equity markets we've already looked at. Then what I do is I switch and start to look at some market internals. So I try to understand sort of that second layer below the market movements. What can I look at that would either confirm or deny what I've seen from a broad technical perspective? So for example, under a chart list that I have called breadth indicators, I'm looking at the percent of stocks on the NYSE and also the S&P 500 above their 200-day moving average. Overall, what's the participation? If I do see weakness in the market, are these holding up, telling you that the average stock is still holding up okay? That's one thing I might want to look at. Here I'm looking at advancers, decliners. So seeing if we do, in the last couple of days, a little bit of distribution. So we're seeing the increase in decliners versus advancers. This is a really interesting one as well, looking at new highs and lows. So now as I see the market appreciating here, look at the number of new highs that we've consistently seen. Now, this visual is actually skewed a great deal because of so many new lows that we had toward the end of December leading into that December low. But the fact that we've had very few new lows tells you that, again, most stocks are still holding up pretty well. And there's plenty of new highs out there, in technology and other places that are moving higher. Once this starts to get increasing, once I start to see stocks making new lows, that tells you that you're starting to see that distribution. We haven't seen it yet, but that might be one of the places where I would look for that. I then continue through to look at sentiment, things like the VIX, volatility, put-call ratios, the AAII sentiment readings. Then I get into a series of ratios, which can be really, really interesting. There was a great chain on Twitter last week, if I remember right, where someone had asked a number of people what their sort of go-to 5 charts would be. If you had 5 charts to get a read on the overall market, what would they be? And I'd encourage you to look that up. You can, if you look at my Twitter handle, DKeller CMT, you'll find it linked on there because I participated, but a number of people did, including a number of the stock charts contributors. And it was really cool to see all the similarities. There are a number of things that were pretty consistent, but also a lot of really unique new ideas that I got from that. But these are some of the ratios that I use to get a read on the longer term trend. One is offense versus defense, consumer discretionary versus staples. And if you see a relative movement one way or the other, this has actually held up pretty well on the consumer discretionary side. If you would see this breakdown, you saw the chart of General Mills earlier. I mean, there are a number of charts within staples that actually look pretty constructive. So if you see more names look like that breaking to new highs, that could actually cause this ratio to turn lower, which would suggest more defensiveness. Going down here with other ratios, I'm looking at the relative performance of semiconductors. That tends to increase during a market appreciation, an up market. So I want to see if that's going to continue. And then I'm also looking at momentum factor and looking at the relative strength.
Hey, Dave.
Yeah.
I got a question for you. Can I just, I know earlier you had pulled up a chart, I think on many of the various indices, and you were showing a chart that had your 21 and 34 week EMAs. And I noticed that you set your PPO to that as well.
Right.
Is there a reason, or is there something that I was just curious as to the 21 and 34 week? How did you come up with those settings? Yeah,
it's a really good question. There are a number of people that do some combinations similar to this. So I've seen, a big Mo indicator, the 13 and 34 week moving averages. I've talked with Arthur Hill about doing the 10 and 40 week moving averages. For me, this is something I've used for years, and it came from a period where, coming out of the lows in 2009, 2010, this indicator tended to do pretty well. It felt pretty good as a way of getting a sense of a general rotation from a bear phase to a bull phase. And so that's what I've stuck with. If you look at any of those combinations, they tend to give very similar signals. So, any long-term exponential averages like this are going to be pretty similar. So when they have given signals that are different, it's only a week or two off for the most part. So again, for me, this is just what I had found to be helpful at a certain point, and have just kept true with for years now.
So if you get like a crossover, is that a sign for you that the trend has ended, or is it just okay, this is a little bit of a warning that we're starting to see some of that momentum change and move in another direction? How do you use that data in your trading? I mean, as you're going through your morning routine and you start to see that 21 week moving average starting to slope over and head toward the 34, does it bother you when you get that crossover? Does it bother you if you get a crossover and the price breakdown? I mean, how do you evaluate that?
Yeah, really good question. So the way that I think of these trend following models is for me, they're not an output of the process, they're an input, right? So instead of, putting money behind this model and saying I want to own it when they cross up to the bullish side and I want to not own or be short when they cross down, for me, it's more of an input to the process. So the models are running in the background, trend following models. And I just want to, when this is bullish, when the, 21 week is above the 34 week, that tells me we're in the type of environment where I want to be adding to new positions. You want to generally be on the long side. You want to be hesitant to be in cash or be short because overall the trend is positive. And then when that reverses, when you see the breakdown, that tells you that we're in the type of environment where you don't want to be adding to a lot of new long positions. You want to be more defensive, more in cash, more on the sidelines if you can. Now, it is not an absolute thing. And that's why I make a point of saying that it's an input in the process. It's not the process on its own. Because in any environment, there are going to be stocks making new highs and stocks making new lows. So for me, this is part of the top-down experience to sort of, what's the overall bias and how do I generally want to be positioned? But then open yourself up to the opportunities that could emerge. So, in a bull run like we've had off of the December lows, I would argue a stock like General Mills would probably be pretty far down your list of, new long ideas just based on where it is sector-wise and the type of business. But the stock's done very well. So opening yourself up for an opportunity in any environment, I think is pretty helpful. So for me, these sort of set the overall bias, but then I'm going to look at the individual charts of sectors, of stocks, of industries, and make the decisions based on those. But it's more, where am I going to generally tilt? And I would say that for me, I guess the evidence needs to be stronger if a model like this is more in a negative position, because it tells you that in general, we're in an environment where the average stock is down versus up. Does that make sense?
Yeah, it makes perfect sense. That was a great answer. There is another question that came in the room. Do you want me to save it till the end, or do you want it now?
No, sure. Go ahead.
All right. The question was, you had talked earlier about the fact that the small caps were kind of rolling over beneath the moving averages, and you talked about the mega caps being above those moving averages and moving higher. So the question that came in from the room was, is this a sign? Is the weakness in small cap stocks a sign of maybe a bull market top? Does that bother you?
Very, very good question. And the short answer is yes. The long answer is as such. I mean, for me, I found, the chart itself is the main thing. So the main thing, the most important thing I want to pay attention to is the S&P 500 if I'm trying to get a read on stocks. And I want to make sure that that's where my analysis is focused. But having said that, looking at the sort of second level indicators, what I would call them, breadth, ways that would sort of confirm or deny what you're seeing from the broader picture. And I would maybe bucket some of the bearish divergences we've seen in the same category. These are things that give you a sense, if the trend is up, I want to be owning stocks. And if the trend is down, I would generally not want to. But looking for some of that, the divergences like that, I think can be really helpful color. So for me, if you look at the small cap chart, the fact that, the S&P is actually above this level. If you think of this as a chart of the S&P, it's already broken above, and it's, sort of above these previous highs that we had back in October, November, and it's sort of up in this range. But small caps are actually nowhere near it. They've pulled back so far, and they found really clear resistance around that level. So in a bullish market, in a long-term uptrend, this is the type of place where you expect to see some strength. You expect to see outperformance, not underperformance. So the fact that you're seeing weakness underneath the broad S&P 500, absolutely, I think suggests, overall that's a sign of a weaker market, not a stronger market.
Okay, cool.
So the only other things I wanted to finish up with, just to sort of round off my own routine, and again, not to get into every piece that I do, but since we've gone through some of these ratios, I then look at the relative rotation graph to understand sector rotations, and again, some really interesting rotations. I saw Julius will be on next week. That'll be a really interesting one to see, because some fantastic rotations with communication services and consumer discretionary, which had been rotating so positively, all starting to turn down on the weekly RRG, which I think is an interesting theme to pay attention to. Then looking at sector charts, some industry charts, then looking at factors and understanding where you might find different types of stocks that are in leadership or laggership roles. And then finally, at the end of this, what I would point out, and again, I have a tab called brokerage, and please do not assume these are the stocks I own. I just put the FANG names in there as a holding place just so you could get an idea of it. But let's assume this is what your current holdings are. The point here is one of the very last things I look at are my current holdings. If you have that at the front of the list, if you have that at the beginning, you are opening yourself up to a number of behavioral biases, most notably confirmation bias, endowment effect, where you are looking at your own positions, and then you will try to gather evidence to justify why you have your current positions. The process for me has been starting with the long-term trend on the first couple tabs, then getting to some of the indicators that will help me characterize that trend or understand the direction and the trajectory of that trend. Then I'm looking at sectors and themes and some other things below that. After all that, and when I have a good sense of where the market is coming from and a sense of where I think it's headed, then I would look at my current positioning and see how that compares to what I've seen. So a lot of times we try to answer the questions in the wrong way. How should I be positioned? And then what does the market look like, basically? And you want to make sure that those are in the correct order. Start with what you're seeing, then look at how you're positioned and see if those are in agreement. And if not, then you now can start to see what have you been looking at before that might earn the right or might have earned the right to be in your portfolio other than some of the things you might have been positioned on. Then from there, you can start looking at individual charts and go forth and sort of go through the rest of your day. But my goal with this presentation was really just to, in some ways walk you through my own process and how I've tried to structure it to help answer those three questions. For me, I'm looking longer term and I'm trying to be prepared, to be aware, and to be ready. And a lot of times I've seen, unfortunately, people set up their process, they set up their morning routine in disagreement with those basic fundamental things that I think we need to pay attention to. So by making some little tweaks to how you go about your process of looking at charts, and particularly the order and how they're set up, I think you can incrementally add a better perspective and hopefully be better suited to make the right decisions for your portfolio. So thank you guys so much for having me on. I really appreciate it.
That's awesome. I do have one other question for you, Dave. Not going to let you get away without answering this one. Okay, so if you've got your own portfolio, so you've already gone through your routine, you're comfortable with the market, and now you're looking at your holdings. If you look at a stock that's in your portfolio and it's still rising, it still looks okay technically, but you're beginning to see it underperform some of the peers. For instance, say Google's going up, but you look at it relative to the internet, it begins to lose some of its relative strength.
Sure.
Do you hang with it as long as it remains okay on its absolute chart? Or do you think about switching out when you begin to lose relative strength?
Really, really good question. And so, I would say that, the ideal chart, and not that Google's the ideal chart, but it's pretty close, to be honest with you, from a technical perspective. I mean, one concerning fact is that it's become overbought again, but overall, you have a clear uptrend in price. You have it making new relative highs versus the S&P. So in general, stocks making new highs that are outperforming and making new relative highs in general tends to be pretty good. Those tends to be pretty good charts that you overall would want to own rather than not own. So when you don't get that agreement, when you don't get that confirmation, when you see charts making new highs, but you see the relative performance going down, and that arguably is what you saw back here at the beginning of 2019. You saw, Google rallying out of the lows, but you see how the relative performance was sort of flat to down over that period because everything was rallying for the most part, rallying out of those lows, and many things even stronger. So there was a disconnect there between the price of this stock and the relative strength. And all that tells you is that there may be better opportunities elsewhere. So the way to think of it, there are two things that I would say. Number one of the best exercises you can do is look at this chart with fresh eyes. If I had new money to invest today, would I put it into this position? And if the answer is yes, then you should be very happy continuing to hold it. If the answer is no, for some reason, for example, like the relative strength is weakening or it's becoming overbought or whatever it is, then you may want to question whether you want to still hold it. And anyways, right? I mean, if you're thinking it's not a good place for new money, should it be a place for old money in your portfolio? So thinking of it that way, not thinking of it as an existing position, do I want to keep it, but thinking of it as this is a new idea, would I feel comfortable adding here? Just reframing it that way a lot of times can help you maybe think about the evidence that you're seeing a little more clearly.
Awesome. Dave, always a pleasure to have you on the show. We've had you a couple times here now in the last week or two, which is awesome. Maybe we can get you back in another week or so. Is that possible?
Always a pleasure to join you guys. I appreciate the time and yeah, thanks so much. Have a great week.
All right. Thanks, Dave.